All right, let's dive into a question that sounds almost impossible to answer. How on earth do you take an entire country's economy, all the chaos, all the buying and selling and creating, and boil it down to a single number? It seems crazy, right? Well, let's break it down.
I mean, you hear this kind of thing constantly. On the news, they'll say something like, the economy grew by 2% last quarter. And it sounds so official, so precise, but have you ever stopped to wonder, what is the economy in that sentence? What is the thing that grew? What are they actually measuring? That's exactly what we're going to figure out.
So here's the fundamental problem. An economy makes just an unbelievable variety of stuff. You've got tons of rice, new cars, hours of legal advice, haircuts. How do you add all that up? You can't just add tons to hours. It's literally adding apples and oranges. So the first step is we need a common language, a common yardstick. And you've probably guessed it, that yardstick is money.
Okay, now to really wrap our heads around this, we need to make a really important shift in how we think about a country's wealth. This is an idea that goes way back to early economists like Adam Smith. We have to stop thinking of wealth as just a giant pile of stuff that a country owns.
This really gets to the heart of it. Just because a country has, say, a lot of oil, doesn't automatically make it prosperous. What really truly matters is the ongoing dynamic flow of production. It's about what a country is actively doing and creating with what it has year after year.
And here's the perfect analogy for it. A stock is like a snapshot in time. How much water is in the tank right now? A flow, on the other hand, is measured over a period of time. How much water is pouring out of the tap per minute? When we measure the economy, we're not measuring the stock of factories, we're measuring the flow of what those factories produce, usually over a whole year.
Okay, so we're measuring the flow of production in money terms. Simple enough, right? Well, if we just add up the sales of every single business, we run into a huge, huge problem. And this brings us to the absolute golden rule of measuring a national economy. So economists have this really clever way of solving the problem. They split all goods and services into two categories. You have intermediate goods. These are the ingredients, the flour the baker buys, the steel that goes into a car. And then you have final goods. That's the finished product, the loaf of bread you buy, the car you actually drive home. And here's the all-important rule. We only count the value of the final goods.
Let's use a super simple example to see why this is so critical. Imagine a tiny economy with just two people, a farmer and a baker. The farmer grows and sells 100 rupees worth of wheat. The baker comes along, buys 50 rupees of that wheat, and uses it to bake 200 rupees worth of bread.
So the temptation is to just add it all up, right? The farmer's 100 plus the baker's 200. Does that mean our little economy produced 300 rupees of value? What do you think?
Nope, no way. If we say 300, we've fallen right into the trap of double counting. Think about it. That 50 rupees of wheat got counted when the farmer sold it. And then it got counted again when it was included in the price of the baker's bread. We've counted the same wheat twice. The elegant solution is to look at the value added at each step. So the farmer started with nothing and created 100 rupees of value. Cool. The baker took 50 rupees worth of wheat and turned it into 200 rupees worth of bread. So they added 150 rupees of new value. Now add up the value added. 100 from the farmer plus 150 from the baker gives you 250 rupees. That is the true value created in our economy.
So, how does this whole value-added thing work when you're talking about millions of businesses? Well, it's all part of a beautiful, bigger picture called the circular flow of the economy. It's the simple model that shows how money is constantly moving between all of us.
Okay, so imagine the economy as two giant connected loops. In the top loop, you have all of us, households, spending our money to buy the final goods and services that firms are making. We spend money, we get stuff. Simple enough. This is called the expenditure flow. But wait, where did we get the money to buy all that stuff in the first place? Well, that's the bottom loop. We, as households, are the ones who provide the firms with labor, land, and capital, the factors of production. And in return for our work and our resources, the firms pay us wages, rent, and profit. This is the income flow. And here's the magic. It's the same money, just constantly cycling through the system. The income we earn from our jobs becomes the money we spend on products. Our spending becomes the firm's revenue, which they then use to pay us our income, and the whole thing just goes around and around. It's a continuous, self-perpetuating loop. Now, because we know the money just goes around in this big circle, it gives economists a really powerful tool.
It means you can stand at a few different points on that circle, measure the flow of money passing by, and you should get the exact same number.
And this is how we get the 3 methods for calculating that big number. First, there's the product method. You add up the value added from every firm, just like we did with the farmer and baker. Second, the expenditure method. You add up all the money spent on final goods. And third, the income method. You add up all the income, every wage, every profit, every rent payment that was earned in the country.
And the truly beautiful thing is, all 3 methods are designed to give you the same answer. Whether you count what's made, what's spent, or what's earned, you're measuring the same underlying flow. You're measuring the national income, which you probably know by its more common name, gross domestic product, or GDP.
So there you have it. That single number you hear on the news isn't just pulled out of thin air. It's the result of this incredibly detailed accounting system, all built on that idea of a circular flow and the golden rule of never double counting. But of course, this leaves us with an even bigger question. Now that we know how the number is put together, what does it really tell us? Does a higher GDP actually mean we're all better off? That's a story for another time.